Hi everyone, welcome to UK USA. I am Aidan Grant again, your host as ever. This is the second episode in our mini-series episode on the impact of the 2024 budget for Americans. I am still joined by Senior Associate Emily Malvasso, who sits with me in our tax and estate planning team. In the first episode, we considered the Americans, so I think you've moved into the UK, and now we're going to pretend like that American is now here and thinking about what the new consequences are for them. So Emily, let us now pretend that we have an American who was not dissuaded from coming to the UK. They decided to come to the UK, and they've now been here for, well, more than that new 4-year period we mentioned in the previous episode, and they're starting to advance upon that new magical 10-year number. Fundamentally, what is that 10-year sort of wall going to mean for them?
So it means that they will now be, so once somebody is in the UK for 10 tax years, they will become essentially treated as long-term residents. And we're saying that term LTRs essentially replaces,
another LTRs.
Yeah, the sort of deemed DOMs or just the fully domiciled people under the previous legislation. And once you're a long-term resident, it means that you're exposed to UK inheritance tax on your worldwide estate.
Which is fundamentally, absent a couple of points we're going to come to later, that's already what people were anticipating happening when they've been here for sort of 15 years on the 15 out of 20 deemed domicile rules. We're just effectively bringing the 15-year period forward by 5 years. So other than those clients who admittedly had been living here for between 10 and 15 years who are going to lose a couple of years, it's just largely pulling forward your planning that you might have thought you had a couple more years for.
Yes, exactly. With the only exception, again, of formerly domiciled residents,
yes,
who would have become exposed to UK inheritance tax on their worldwide assets from their second year of UK tax residence under the previous rules. They now have a new, 10-year period during which they're outside of the scope of tax.
8 years.
Foreign assets. Yeah. Which is excellent. An excellent result for FDRs, really.
Which now I think about it, I've not thought of this till now because I still pass in a lot of information. How long has it been since FDRs were introduced? 8 years.
Yes.
So it's almost like they thought about it. So that worldwide exposure is fundamentally not a seismic shift by itself. There are a couple of different places where new inheritance tax exposure is going to come in, which we are going to kind of digest when we think about other people impacted by these rule changes. But I do just want to reflect them here initially, because this is going to be highly relevant for someone thinking about the consequence of that 10-year period. One is trust assets and one is pension assets. Do you want to sort of elaborate on whichever one of those in whichever order you prefer?
So obviously, it was widely covered in the budget, and one of the loopholes that the Labour government intends to close is around excluded property trusts. So essentially, under the new LTR regime, if we're going to call it this, once that 10-year period has been reached, any trusts that were settled by the individual who's now a long-term resident of the UK will lose their excluded property status, and it means that the assets within the trust are now within the relevant property regime, which means that for inheritance tax purposes, those assets will now be subject to 10-yearly charges and also exit charges at a sort of maximum rate of 6%. There are obviously exceptions, so assets settled before the budget will not necessarily be counted into somebody's estate for inheritance tax purposes. But the main point is that these assets that previously could have been indefinitely sheltered from UK inheritance tax are now back within the scope.
Which is not necessarily terrible, because if they put the assets in trust, they were moving from them being in their estate at some point in the future to being, permanently outside the state, the scope of tax. Now we're saying they're kind of permanently in the scope of a 10-year charge at 6% every 10 years. How impactful is that? It may well be for a lot of clients. That's still better than keeping the assets in their own name. Each client's going to have to decide whether they want to keep the assets in trust, whether they want to dismantle the trust. But I think that sort of gift with reservation of benefit point you made about assets put into a trust before the budget is going to be relevant here, because it means those that did create these trusts, quote unquote, a while ago, coming to this with existing planning in place, we've not got the terrible sort of worst case scenario of the assets being inside their estate for inheritance tax purposes and also subject to the relevant property regime, which is kind of the worst of all worlds.
Yeah, exactly. They can benefit from them, and also, obviously, the way these trusts will work is that if the settlor remains a long-term resident and is a long-term resident as at their death, those trusts will continue being subject to those relevant property charges. But I agree that, a 6% periodic charge to pay is better, arguably, than the significant entry charge at up to 20% inheritance tax that has been avoided because the assets were transferred into trust at a time where it was efficient to do so for them.
And if you decided you were someone that decided to leave the UK and you wanted to take your trust with you, that's also totally fine. There may be an exit charge on the point at which you cease to be a long-term resident after that tail we talked about in the first episode. But again, that's a kind of one-off charge of up to 6%. And at that point, it then is outside of the regime. So I think
seems a small price to pay to a certain extent. But
there was a lot of doom about the impact for trusts settled, and Americans like trusts, and Americans use trusts quite frequently. We would have always said to an American bringing a trust to the UK, take advice anyway, largely from the income tax accounting gains tax perspective, trying to maximize the validity of foreign tax credits. None of that's changed. We're still saying take advice. It's just that trust becomes slightly less tax efficient than it did previously. So that still is the case. It just needs to be discussed whether you keep the assets within the trust or you take the assets out of the trust. But I think it's slightly brighter horizons than we first thought.
Yes, I agree. And I think ultimately the impact will be that people will decide when they come close to that sort of 10-year residence point, whether they are happy, with their inheritance tax exposure, knowing that there isn't the easy fix that there was before in terms of creating excluded property trusts, but knowing that there's still, tax efficient measures. And as you said, the trust structure doesn't have to be as inefficient as, people initially thought.
No, true. But that's not to say that other methods of efficient lifetime planning don't work, like lifetime gifts, for example. The outright gifts that someone can make if they're excluded property as they were approaching year 15 are still the lifetime gifts they can make as they're approaching year 10.
Exactly.
They just got to think about that. Yeah, exactly.
And obviously the other major point that was announced at the budget was that pensions would now become subject to
quite assassin the pension one.
Yeah, inherited pensions. And that will be an issue for multiple people, and I think it's particularly important for people who leave the UK as well with big pension pots, thinking that those assets are not taxable, whilst they now are UK cited as taxable IHG assets. So, but anyway, that's also for another discussion.
But for these clients, where we might have tried to say to clients previously, your foreign pensions, your foreign IRAs might be treated as pensions in the UK and therefore might be exempt from inheritance tax. That's a bit of planning that, so far as we can tell, in the just under a week we've had since the budget, probably largely fallen by the wayside. Those foreign pensions are just regular accounts now. It's either excluded property or it's a pension account and it's chargeable to inheritance tax.
Yeah.
So,
and I think people will have to think really carefully about their nominations now.
Yeah.
It was sort of standard practice to nominate your pension to pass even directly to your children rather than to your spouse.
Because it's already exempt.
But if you're now having to secure the spousal exemption on that pot too, then you either have to update those nominations or potentially consider withdrawing them entirely so that the assets in pension can pass in accordance with the terms of your will.
Oh, I feel like you're Martin Lewis giving us some key important sort of financial planning. We don't give financial planning advice, but you're giving us sort of real, sort of tangible benefits. The other thing I want to touch on when we're thinking about these people that are approaching 10 years, because what they are people that have been in the UK for some time, are people that, not to do with inheritance tax, but people that maybe were at one point inadvertently on the remittance basis or had not appreciated the consequences of being on the remittance basis and are now here. And as a result of these new rules coming in, might be thinking, gosh, does this affect anything that was previously taxed? We do have this new temporary repatriation facility, the TRF, that clients will be able to take advantage of, which may also be impactful for Americans.
It's a new grace period, essentially, where you can remit funds for 3 tax years at, I think, a rate of 12% in the first 2 tax years and then 15% in the last. And that's obviously a significantly lower rate than they would be exposed to otherwise, up to 45%.
I mean, for a lot of sort of non-dom clients, we might talk about that TRF as being useful when, they were maybe running out of clean capital. They were doing clean capital planning and they were putting none left so they could get more funds into the UK. But for Americans, where it's going to be impactful is, let's say you're someone who's been in the UK and were filing correctly and knowledgeably, ignorantly, etc., on the remittance basis. You paid some US tax on a portfolio overseas. You now feel like you can't bring that money into the UK for fear that you're going to pay an additional tranche of UK tax, having already paid US tax without a credit available. We're saying to you, hey, you can bring that money in for only 12%. You're probably not going to do better than that. Better to pay that 12% than otherwise try and bring it in and pay 45%.
Yeah, exactly. And especially for all those people who were perhaps wrongly elected into remittance bases before, when they arrived into UK, not having sought the proper advice for their circumstances, and they now have the option of fixing that essentially by bringing everything back in with a smaller tax penalty.
So this is me talking directly to all the accountants and the wealth managers that are now listening to this episode. Talk to your clients about the TRF. It might be quite useful.
Yeah, and we've only got it for a short period of time.
Exactly. It's not going to be available for long, so make the most of it. Right. Emily, I think we will leave it there for the second of those mini episodes we're doing. Don't want to, tease too much without getting to our third episode, which next time we'll be thinking about the Brits who left the UK, maybe living in the US, and thinking about what the consequences of this budget are going to be from then on the other side of the Atlantic. So to you, the listener, thank you again so much for joining us this episode.